Hello financial fans, welcome back to another stock analysis. Today we'll be covering Target Corporation stock ticker TGT. Target Corporation is an American retail corporation that operates large discount stores as well as a chain of smaller format stores. The company offers a wide range of products including clothing, electronics, home goods, groceries, and health and beauty items. Target is known for its signature bullseye logo and its commitment to providing guests with an exceptional shopping experience, including services such as order pickup, drive up, and same day delivery. The company operates over 1,800 stores in the United States and is expanding globally with a focus on delivering the convenience and value that its guests expect. They currently are sitting at a market cap of $83.3 billion, and in 2021 they generated a revenue of $106 billion. The dividend yield is sitting at 2.39%, and they're dividend king with their 51 years of consecutive dividend increases. 26% of their revenue is generated through beauty and household, 20% from food and beverages, 19% from home and decor, 18% and the remaining 17% from apparel and clothing. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the health, and the growth of the company. We'll be using a standard margin of safety of 25%, and this margin of safety can never be below 0%. Margin of safety will increase based on the ratios that we're going to look at in a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from a margin of safety. The first two metrics that we're going to look at are the EBIT growth and the margin growth. The EBIT has grown, going from $5.7 billion in 2013 to $9 billion in 2022. The average growth during this period was 6.7%, meaning no change in the margin of safety. Margin has also gone up, going from 7.9% in 2013 to 8.5% in 2022, which is a 1.6% average margin growth, meaning a 5% deduction from a margin of safety. The next two metrics are the dividend growth and the payout ratio. The dividends have gone up significantly, going from $1.20 a share annually in 2011 to $4.32 a share annually in 2022. The average growth in dividends during this period was 12.8%, meaning a 10% deduction from a margin of safety. This, while the payout ratio is sitting at a very solid 54.2%, meaning no change in the margin of safety. The final two ratios that we're going to look at are the debt to EBITDA and the return on invested capital. To get a debt to EBITDA ratio, we have to take the debt, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For Target, this is just under 1 year, in this case a 90% debt to EBITDA ratio, meaning 5% deduction from a margin of safety. The return on invested capital is sitting at 10.7%, meaning no change in a margin of safety. Looking pretty good so far for Target. So let's go look at the valuation models next to determine the intrinsic value of Target. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2013 to 2022. The average growth in free cash flow during this period was almost 17%, and I'm projecting a 10-year expected free cash flow growth of 7% annually. With this percentage, we can determine the future free cash flow for Target and determine the terminal year of valuation, using a perpetual growth rate of 3% and a discount rate of 8.5%. Summing up all of the free cash flows and making them the present value, you get a sum of free cash flow of $120.6 billion. All that's left to do to get an equity value is add the cash and equivalents and subtract the debt, leaving us with an equity value of $110.1 billion. To get our discounted cash flow price per share, then, all that we have to do is divide it by the amount of shares outstanding, leaving us with a discounted cash flow price per share of $239.26, and with the current price of $171.94, we get an upside of $67.32 out of this model, which is a 39.15% upside. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts going from 4 years ago to the current year. The average growth rate in dividends during this period was 14.6%, and I'm projecting an expected growth rate in dividend for the future for Target of 6.5%. We'll be using a discount rate of 9% in this valuation model once again. And out of this model then, we get a discounted dividend model price per share of $184.03. And with the current price of $171.94, here we get an upside of $12.09, which is a 7% upside out of this model. Final model that we'll be using is the multiple valuation. In this model, we'll be looking at similar companies to Target, look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry that Target operates in, which in this case is 29.83. All we have to do to get our fair value is to multiply by the earnings per share that Target is generating, which is $7.32 a share, leaving us with a fair value of $218.33. With once again the current price of $171.94, we get an upside out of this model of $46.39, which is almost a 27% upside. Let's go look at the final overview of our valuation models next. Looking at our final overview, we've imported the discounted cash flow, the discounted dividend, the multiple valuation price per share, leaving us with an average of $213.87 a share. We have determined the margin of safety earlier, using a standard margin of safety of 25%, deducting it by 5% for the margin growth, deducting it by 5% for the debt to EBITDA, and deducting it by 10% for the dividend growth, leaving us with a margin of safety of 5%. Applying this margin of safety, we get a fair value of $203.18, and with the current price of $171.94, we get an upside of 18.17%, so in this case, it would be a buy. If there's any other dividend companies that you would like to see me cover in this channel, please let me know, and thanks for watching.